Hey, folks, let's say we get started talking about exam one. What do you? So we've got a lot to discuss and only about 50 minutes to discuss it. So let's go ahead and get started. Um, just some preliminary information about the exam. Please bring a writing implement with you when you come take the exam. I recommend a pencil and eraser because it's very hard to erase pen, or it's very hard to correct pen. I also recommend you bring a calculator. In fact, I recommend that you bring two calculators. It's always my idea because if you bring one calculator, you'll be fine. But if it breaks down, you want to have a backup. So bring a nice calculator and then bring one of those janky calculators that you get out, like when you go visit Becker and they give you a free calculator because like all accountants want calculators. Also, you get to be a hero if somebody else has their calculator break down or they don't bring their calculator. There will be minimal calculations on this, but there will be calculations on the exam. Um, as far as the exam goes, it will be pretty much the same breakdown as on the practice exam. It will be one question from chapter one question from chapter two, and then roughly three questions each from chapters 3, 4, and 5. One of those chapters will have an additional question tossed in. I'm not going to tell you which one. It's just going to be one of them. And then the problems, there will be two problems, and they will cover content from chapters 3, 4, and 5. And it will be a pretty wide array of content. As far as the rest of the information goes, I'm going to go through the study guide. I'm going to go through it pretty quickly. I used to go through it line by line, and I ran out of time when I did that. So I'm going to cover some of the higher points. Again, if I don't cover something and you have a question about it, please raise your hand and let me know. I'll stop at the end of the study guide, and I'll also ask if there are any questions or anything that you need to talk about. All right, so chapter one, principal-agent relationship. That's pretty straightforward. We talked about it in depth. One thing that's not on the study guide that you probably should know about the principal-agent relationship is this concept of information asymmetry, why it's important. Remember, information asymmetry basically says that the agent knows more about the operations of the organization than the principal does. And that's basically what the auditor is trying to mediate, is trying to fix that information asymmetry problem. Management audit assertions. You're going to hear me talk about these again in chapter 5, but basically probably goes without saying, know these really, really well. When I say know something, by the way, I'm not saying memorize the words. I expect at a minimal level you have them memorized. Knowing something goes beyond that. It's basically knowing what the definitions are and how to apply those in various situations. This is one of the more important concepts in this course, and so you need to make sure that you have a very strong working knowledge of all of these. Assertions about transaction events. Remember, it's all assertions but rights and obligations, and assertions about count balances at period end. Remember, that's all assertions except for cutoff and authorization if we count it as a true assertion. All right, 4 types of audit reports. I would make sure that you have at least a reasonable understanding of what these entail. We talked about these back in chapter 1. So remember, unqualified report, that's basically the clean opinion. That means everything is just fine. ASB has a different term for this. They call it the unmodified opinion. And so that's the only one that has different terminology, but they mean the same thing. Everything is fine. Their financial statements are free from material misstatements. Qualified opinion. Qualified opinion is characterized by 2 words. Does anyone remember what those 2 words are? Except for. So basically we're saying everything is fine except for whatever is discussed below. Adverse opinion, that is basically the financial statements are materially misstated. The only way that can come up if there's a pervasive departure from GAAP. And disclaimer of opinion, that's basically saying we couldn't do our job. That's a pervasive scope limitation. I forgot to mention qualified opinion can come up either from a material departure from GAAP or from a material scope limitation. Also, the term scope limitation, I like to use that term a lot, but what does it mean? Well, the scope represents the breadth of work that we do as an auditor. If we are unable to do some of that work, that's a limitation to the scope of the work we're trying to perform, okay? So scope limitation basically means we could not do part of our job. The major phases of the audit, remember we talked about those: planning, risk assessment, test of control, substantive procedures. Those are kind of the major phases. One of the keys to any audit exam, this is not just this exam, but any of the rest of the exams in this course, and if you plan on sitting for the CPA exams on that in that area, know what phase of the audit you are in a particular part. So if I say which of the following would most likely take place during the planning phase, you need to understand what areas are covered in the planning phase, which is primarily chapter 3 stuff. Also, it's important to note that risk assessment, test of controls, and substantive procedures, Those are three phases of the audit that we can gain assurance. We don't gain any assurance during planning, which basically means that we don't gain any confidence about the state of the client. And then test of controls and substantive procedures, in addition to being assurance gathering steps, we also test assertions during those phases. So those are important to know the distinction between. Chapter 2, I'm not going to talk too much about chapter 2. There's some minor stuff in there. There's going to be a question from it here, but it's pretty straightforward. Chapter 3, let's talk about some areas that you might want to be very aware of. Make sure you understand the reasons why a client might want to leave, or why an auditor might want to leave an existing client. They're minimal, but they're very important to understand. There were two reasons: contentious client and disputes over accounting fees. So those are the primary reasons. Primary sections of the engagement letter. That was not in the slides, but I talked about it at length. There are three primary sections of the engagement letter. There's the objectives of scope and the audit. There's management's responsibility, and there's the auditor's responsibility. Now, when I say know those again, it's important to note that just knowing those words are not sufficient. You also need to know what is management's responsibility and what is auditor's responsibility. Management's responsibility is generally characterized by they have to be responsible for preparation and presentation of the financial statements, and then they're responsible for design and implementation and maintenance of internal controls. Okay, so basically, creation of financial statements and internal controls, that's management's responsibility. Testing those, that's the responsibility of the auditor. That's the easy way to think about it. Moving down, where it talked about the audit strategy, the scope of the engagement reporting objectives, and the focus of the audit team's efforts, I think it will probably be worthwhile for you to review in the chapter 3, part 1 slides, slide number 11, which talked about all the different aspects of the audit strategy and plan that could be appropriate to an audit. You may want to review those to make sure you have a detailed understanding of those items. Let's see. Related parties. So related parties, remember, one of the concerns about related parties is that transactions with related parties may not be at arm's length. What does the phrase at arm's length mean? It's an idiom, but it's a really important one. So at arm's length basically characterize how you would do business with a non-related party. So remember the visual example we give is like you do business with a stranger and you conclude the business, you shake hands and say, let's go ahead and do things. All right. You do the same business with your brother-in-law or with a family member like your mother or something like that. And you say, okay, we're going to do business together. You don't finish by shaking hands. That would just be weird. But you give them a hug, okay? Because that means that it's closer than arm's length. Arm's length transaction basically measures what kind of business you would do with a non-related party. That's what we're looking for with respect to related parties. And by the way, related parties does not just have to be a family relationship. Anybody who has any kind of pre-existing relationship that can be measured either by family relationships or monetary relationships could be a related party. All right, phases in audit testing. These are very important. Sorry, I'm going to sneeze. Apparently, I'm allergic to phases in audit testing. I think it may be the first time I've actually ever sneezed in the middle of talking. Wow, weird. I didn't even sneeze. I was just, okay, I got to stop. All right. Phases in audit testing. Okay. The reason that the word testing is used here is because these are the phrases that we gain assurance. So risk assessment procedures, test of controls, substantive procedures, which includes analytical procedures and tested details. So make sure you're familiar with those. Also, with respect to steps of materiality in an audit, please refer back to the Wilson-Adams materiality guidelines. Those are a good guide for how we actually assign materiality. I'm probably not going to walk you through a detailed materiality exercise, but it's possible that I will call upon some of the things you learned from the earthware clothiers activity. Chapter 4. So definitions of audit risk, inherent risk, control risk, and detection risk. Probably important to know those, especially since they were on the practice exam. So I think those are important concepts. Which of these does auditor have control over, by the way? Detection risk, because that determines the scope of substantive procedures. Very good. Moving on past this, during risk assessment procedures, there are 4 types of evidence an auditor can gather. 3 of those you should know off the top of your head: inspection, records, documents, observation, and inquiry. Why are those 3 so important? They can be used in any phase of testing, okay? Any phase that utilizes audit testing, those 3 procedures can be utilized. Analytical procedures can also be utilized here. Those are preliminary analytical procedures. We'll talk about analytical procedures a little bit more in depth in just a second. All right. With respect to categories of fraud, we talked about two categories. You do need to be able to define each type. These are not exclusive. These are not the only types of fraud that you will see if you have any knowledge about fraud, but these are the two that we're concerned about as auditors, the ones that we're most concerned about because they have financial statement impacts. Fraudulent financial reporting, that's misrepresentation of financial information, and then misappropriation of assets. What's another word for that? Theft. Yeah, theft. Just make sure you can understand that. Something I don't really highlight, but I think probably is a good point. I frequently asked a question on factual, judgmental, and projected misstatements. Make sure you understand the difference between those. I gave three pretty clear examples of each of those, or one pretty clear example of each one of those to delineate those. If I ask a question on that, make sure you understand the difference between those. Conditions indicative of fraud, the fraud triangle. These are fraud risk factors. What do they represent? Well, remember that they incentive or pressure basically is what is motivating the fraud. Opportunity is the situation that allows the fraud to happen, and rationalization or attitude of rationalization is basically the mindset that allows somebody to actually commit a fraud. There's a lot of very clear examples on that. Make sure you can define each of those and you can identify examples of those. Easy way you can do this is analogy to the course because we talked about that. If you wanted to cheat in Dr. Barnes' class, how would you do that? Well, the pressure is you need an A in the class. The opportunity is Dr. Barnes likes to play on his iPad when tests are going on. All right. The rationalization, Dr. Barnes is kind of a jerk. Okay. Now, those are all kind of low-hanging fruit, but that's an easy way to clarify what you mean by those types of fraud risk factors. In a business environment, it's not too much different in those. All right, moving on to chapter 5. Chapter 5, I said, was the most important chapter. That's why I've got management audit assertions, again, because it's important. Make sure you know the two categories of assertions, the relative assertions for each, because remember the two categories of assertions are transactions and events and account balances. What's the difference between those? Why, when I say transactions and events and account balances, you're going to say, it doesn't really matter, Dr. Barnes, because they have common assertions between the two of them. So what's the difference? Can't answer, I'm walking out the door. What's the door's noisy out there? I don't like anybody being louder than me. So transactions and events relates to basically what is happening on a daily basis. What's the day-to-day operations of the organization? Account balances relate to the information that's in the financial statements, primarily the financial statement balances of accounts in there. So even though the assertions may be similar between the two categories of assertions, they mean distinctly different things in context. All right. All right, phases in audit testing. We just talked about the types of evidence that can be collected during risk assessment procedures. Test of controls. Test of controls can gather 5 types of evidence. So we know 3 of them off the top of our head. Inspection records and documents, observation, inquiry. What are the other 2? Reperformance. Yes, that's commonly used as a contrast test of control. And then one that's weird because it's not one of our listed types of evidence. Walkthrough, which is basically a fancy combination of all the others, okay? The substantive procedures can utilize all types of evidence, okay? Speaking of all types of evidence, look at that. We got all these types of evidence here, and you might want to note for the evidence, what are you going to be required to know? Well, there's probably a pretty good guide given that I've given you all this information on here. So let's just talk through this, okay? For the types of evidence, you need to be able to define the type of evidence and what it does. You need to be able to identify which management assertions it tests, okay? You need to be able to define the reliability, the relative reliability level and why. And just like we talked about, you need to identify which phases of the audit it can be used. That sounds an awful lot like our discussion from chapter 5, and it's identical to our discussion from chapter 5. So if you were taking good notes or listening really closely in that, you should feel pretty good. If you don't, you might want to go back to that lecture and just watch that section over again to make sure you understand it. This is all detailed here in the study guide. Please make sure you have familiarity with all of those, okay? Because I have asked questions. So let me put it this way. There's a 100% chance a question over the evidence will come up as well as the assertions, okay? I have frequently asked short answer questions where I said what types of evidence and what assertions are they testing and different questions in that area. So it's a lot of information, but I expect you to know that information because it's so important to the context of this course. So even though you probably say, Dr. Barnes, you said you don't like memorization. I don't, okay? But I think that this is really important to understand. It's really important to follow. Okay. Documentation. Okay, remember documentation. Oh, let me go back real quick. So when I talked about assertions, okay, I said assertions are the correct term for them are management assertions, but I may frequently say audit assertions, or I may just see the word assertions. Those are all interchangeable. All right. When I say evidence, I may say testing, I may say procedures. Those are all interchangeable. They mean the same thing. Documentation. Documentation, I may say work papers or working papers. Those are all interchangeable. Make sure you understand all the terms for those. Okay. I know it seems like a lot to absorb, but it's important to get used to using all of those terms or the interchangeable terms. What is the function of audit documentation? This is something that it kind of gets overlooked in the past. Is there's actually an entire slide dedicated to this particular concept, but it's been overlooked in the past. So remember, function documentation. We want to support the audit report. Whatever the conclusion or the opinion that we reach in the audit report, our documentation should support that. We want to have as an aid in planning, performance, and supervision of the audit. So how the audit is conducted, we should be able to use our working papers to guide that, and as a basis for audit review. So anybody who comes in to review our work can actually look at the documentation and understand what happened. So support, aid, review. Those are kind of the important keywords to remember for that. Formatted documentation. This is one I think that is the most important concept with respect to documentation. It gets overlooked quite a bit. All documentation should have standard elements. Should have a heading, which basically is saying what the documentation is, what the name of the company is, what the period under audit is. Heading would also include a notation about what the work paper reference is and who created the work paper and what the date was. We have indexing cross-referencing. So that indexing notation should actually say where it falls within the work papers. Cross-referencing was one of those things that I think is overlooked, but that's saying that any work paper you have should have a reference to a previous document or a subsequent document, and whatever that document is should refer back to that original work paper that's created. So the example is an accounts receivable work paper, like you were doing a accounts receivable testing, would have a work paper reference of C7 referring back to and it refers back to the balance that's in the accounts receivable in the trial balance. If you go back to the trial balance, and trial balance will say is A2, you're going to find a C7 notation on that work paper referring back to the testing for accounts receivable. That's cross-referencing. And then tick marks. Tick marks are just shorthand notation for whatever processes are done in a work paper. Instead of writing out everything every single time, long sentences for every single test or every single document, we use just little tick marks, like the letter V or the letter F or the letter or symbols, like a circle with a slash through it or a check mark. Anything like that can be a tick mark. All right. And analytical procedures, make sure you know the types of analytical procedures. Remember, we did a couple of forms of reasonable analysis. You should be able to prepare an analytical procedure similar to that one that we worked through in class. I'm going to tell you this, and this always makes people panic. Please do not panic when I say this. I may ask you to prepare an analytical procedure that we have not done in class, okay? Now, that does not mean that you have not done it. It means that it's something that you've done in a previous class that you actually have to work before. So, for example, if I asked you to say, can you calculate an expectation for depreciation expense? What I'm effectively asking you is, have you calculated depreciation before in one of your classes? The answer is yes, you should be able to remember that. I promise you, if I ask you to calculate something like that, it will not be not outside the scope of your abilities. It will be a very simple calculation that should be able to recall like that. If, like, say, for example, I asked you to do straight line depreciation, I'd be very disappointed if somebody in this room did not remember how to do straight line depreciation. Do we need to have a prime run depreciation, by the way? Does everybody feel pretty comfortable on that? Okay. All right. I see a lot of people are just kind of like, yeah, I'm good. And the people like, all right. I'm going to take it as a sent. Additional stuff, make sure you review the EWC stuff and the takeaways from the WAVE activity. And that's the study guide. Are there any items that I did not discuss that you would like to have clarification on or talk about coverage? Yes. Can you just quickly explain the difference between recalculation and so a recalculation is taking client information, detailed client information, and actually performing a recalculation of how that number was achieved. So an example would be, say they had allowance for doubtful accounts is the easy low-hanging one to identify. So we know what the assumptions are. We know what the balances are in each of the accounts. We can calculate based on how many days it's outstanding, what the balance should doubtful account should be. An analytical procedure is more about developing an expectation based on high-level detail, high-level data. So could we perform an analytical procedure over allowance for doubtful accounts? Yes, but it would be based on much, much higher level detail. You'd be guessing on averages. You'd be guessing on estimates of what certain balances would be and what the items are. So think about it this way: when you're doing a model for accounts receivable, you're probably looking at financial statement information and not transactional level detail. So recalculation is going to be more in depth and more ingrained. They both test VAA, albeit at different levels. So it's a good question, though. All right. So yeah, any other questions? All right. It's time you've been waiting for. Let's see how you guys did on the practice exam. By the way, this is a actual exam from a previous course, so this can kind of gauge where you're at with respect to in this course. So listed below is 4 types of opinions can be issued in a PCAOB report. Which of the opinions is referred to by a different term by the ASB audit report? We just talked about that. That's the unqualified opinion. It's actually referred to as an unmodified opinion. By the way, if you're ever wondering if there's any meaning to the sequences that I provide up here, 95% of the time, whenever I put a sequence up there, it's going to be in alphabetical order. Okay. So was I trying to fool you by not putting unqualified first? And no, unqualified's last alphabetically. That's why it's the last answer. So if you're trying to say, he put that last, but he talked about it first in class, there's got to be something to it. No, it's just alphabetical. That's all there is to it. What is the name for the set of rules created by the AICPA that detail ethical and professional responsibilities for public accountants and in particular auditors? We talked about that briefly, and the answer is the Code of Professional Conduct. We will actually go into more depth on that. It's a very big area, especially for auditing public companies or auditing of any companies, that we need to know what the nature of profession is. Has a lot to do with independent standards and guidelines for people in professional practice. I think I made it the other 3, to be honest. But if you answered any with the other 3, I guess it would be a pretty good answer. Which of the following tasks should an auditor complete as part of the determination of whether to accept a prospective client for an audit engagement? So effectively, when you ask this question here, is that we're asking which of these types of procedures belongs in the planning phase? Okay, specifically at the very beginning of the planning phase when we're talking about whether or not to accept a client. So document the necessary scope of testing. Keep in mind, substantive testing, keep in mind that we document that after we perform test of controls because we know what control risk is and we can determine detection risk. Evaluate the operating effectiveness of the client's internal controls. We probably need to perform test of controls before we do that, so that's going to be much later on. Make certain inquiries to the client's predecessor auditor. That sounds like our answer. We're going to talk to whoever the previous auditor was, say, hey, why did the client get rid of you? I said, because the client is bad. If that's the case, we probably don't want to accept them as a client, okay? But if they say, yeah, we were just a little bit too small for their needs and they need a bigger auditor. And then request the client's legal counsel provide information about recorded contingent liabilities. That's a request we make near the end of the audit after substantive testing. Consider the items listed below: competence to do professional care, objectivity, and value. Which of the items are factors that an external auditor must evaluate when assessing the reliability of the internal audit function? So there's 3 items. One of them is a systematic and disciplined approach, but that's not listed up there. What are the other 2? Objectivity and competence. Yep. So that's going to be 1 and 3, B. Which of the following statements regarding audit committees is correct? I'm not sure how I feel about questions like these. I think these types of questions can be really, really difficult and bad, but I do think they test your knowledge of questions in this area. So let's just talk really quickly before we go through the answers. What are some characteristics of audit committees? So subset of the board of directors, the members have to be outside independent, basically meaning that they can't be members of the executive committee team, or they can't be members of management. Also, has to be financial expertise on audit committee. How many members have to be financial experts? 1. Okay. I'm glad you all hit up that finger, not a different finger. So thank you. All right. One financial expert. Okay. So audit committee is comprised of a subset of all the entities, shareholders, and creditors. No, it's just only the board of directors. Audit committee for a publicly traded company is subject to regulation or SOX must be comprised entirely of financial experts. That would be a great audit committee, but that's not a requirement. Audit committee for a publicly traded company is subject to regulation or SOX must contain at least 1 member of company's management. They have to have 0 members of company's management. That's an independence issue. There are no specific composition requirements for audit committees held of privately held companies. That is true. Remember the details we just talked about, those requirements, those are under the Sarbanes-Oxley Act, which is for publicly traded companies only. Private held companies have no requirements in this regard. Question number 6. As a general rule, an auditor calculates planning materiality at 5% of pre-tax income for its audit clients. In which of the following situations might an auditor use an amount other than pre-tax income for planning materiality? So there are two types of questions we can ask here. We can ask, okay, what is the basis, or what is the basis we're going to use? So 5% of pre-tax income. And the second, that's the quantitative basis. The qualitative basis asks, are there reasons that we might want to use it in a percentage other than 5%? Or if we're using a different basis, a different percentage other than 1% of total assets or something like that. That's the qualitative consideration. In this case, we're asking about a quantitative consideration, all right? So let's just go through these. Client is a privately held profit-oriented company. Is that a quantitative consideration? It is, but would this necessitate using a different base other than pre-tax income? No, it's still a profit-oriented entity, so that makes perfect sense. Client operates in a mostly unregulated industry. Is this quantitative consideration? No, this is a qualitative consideration, though it's probably not going to actually result in any change because this is going to be no risk whatsoever. Unregulated industry generally is going to be lower risk for most organizations, so we wouldn't change the percentage. Client has had material misstatements in prior year audits. This is a qualitative consideration also, and this is one of those ones where we'd say, look, there's risk present here. We probably want to use a lower percentage of pre-tax income, but we can still use pre-tax income. So then we have the client as a financial services firm or mutual fund. This is our answer. This is a quantitative consideration. Why don't we want to use our pre-tax income? Because their primary business line is based on assets, the use of assets. And they have so much more in assets than they do in income that we probably want to use asset as the basis for testing their operations. So that would be answer D. Auditor may be exposed to financial loss or damage from his professional reputation from litigation, adverse publicity, or other events arising in connection for audit of financial statements. What's the term for this type of risk? I didn't want to cause any confusion and provide any of the audit risk net measures, because especially since audit risk is talked about later on in the practice exam. But this is the example of engagement risk. This is where basically if we accept an engagement, then we are liable for whatever the outcome of that engagement may be. All right, Cressy's hypothesis states something, 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 are aware this problem can be secretly resolved by violation of position of financial trust, something, something, something. Which fraud risk factor best represents the underlying text? So if we can resolve the financial or the violation by being in a position of financial trust, that means that we have an opportunity to commit fraud, okay? We have an opportunity to commit fraud. So financial problem that's non-shareable, that's pressure. Apply their own conduct in a situation that enabled them to adjust their conceptions of themselves as trusted persons. That's rationalization. And corruption, that's just a different type of fraud. Auditor decides to test a sample of client sales transactions to ensure that the sales were recorded in the proper period. Which manner of assertion is the auditor testing? So something being recorded in the proper period is which assertion? Cutoff. That's a cutoff assertion that we're concerned about there. Yes. That's a pretty straightforward one. All right. As part of testing the client's property, plant, and equipment, an auditor determines that it should verify management's assertion of existence occurrence related to fixed assets that were acquired over the past year. Which type of audit procedure would provide the most reliable evidence related to this assertion? Well, if you know what one of the primary ways of testing existence occurrence to really large assets are, this was a pretty easy question. So analytical procedures. First of all, can that test existence occurrence? Nope, it cannot, okay? Plus, it's not a very high reliability assertion or high reliability test. It's only medium reliability. Inspection of records and documents. Can we test existence occurrence of that? Yes, but it's not particularly high reliability. It's like medium. Inspection of tangible assets. So can that test existence occurrence? Is this something that would be probably appropriate for testing PP&E? Yes, very appropriate. Is it high reliability? Yes, we have 3 yeses, so I'm going to say 3 yeses is enough to circle that as our answer. Recalculation. Recalculation is a high reliability test. What's the problem with circling that one here? It doesn't test existence occurrence. It tests VAA. Okay, so you have to make sure you understand what assertions it tests as well. An auditor decides to send confirmation to a sample of clients' vendors in order to test the reported balance for accounts payable there's typos all over the place that I have not corrected here. Which phases of the audit is the auditor most likely to conduct this testing? See, this was written on an old version of Word. You can tell this is an older exam because it doesn't automatically pick this up and say, yeah, this is screwed up with phases of the audit. What the heck? All right. So which phase of the audit is most likely to conduct testing? Assuming you knew what I was talking about, what about confirmations during risk assessment? Is that a good idea? No, we don't use confirmations during risk assessment. Remember, a risk assessment is limited to inspection records of documents, observation, inquiry, and preliminary analytical procedures. All right, test of controls. We sent some confirmations out then, right? We never use confirmations during test of controls. Remember I said that was one of those absolutes that was true in this course? The word never, that applies for the practice exam too. We never use confirmations as a test of controls. Confirmations is a test of account balances. Test of controls are related to transactions and events. It just doesn't line up. So that leaves one left, substantive procedures. Well, that's the only one we've got. And hopefully we're going to get 1 out of 3. That's correct. We will use confirmations as substantive procedures tests. All right. Sally Seidel is preparing analytic to develop an expectation of previous year's sales revenue for a client, the Broken Arrow Performing Arts Center. That's not my mom's name, but that's who I'm referring to. She actually works at the Broken Arrow Performing Arts Center as a volunteer worker because she's retired, but she still works there. They have 2,400 seats divided equally between 3 sections. Information regarding average seat pricing and percentage of seats sold is shown below. They had 10 shows per year. What's Sally's expectation of the BAPAC sales revenue? This is pretty straightforward. All you have to do is multiply these out and add them together. And then you have to multiply times 10, which means you came up with 1,016,000. Okay. I basically asked you to do math on that one. And if you were able to do math, you got that one correct. All right. You've been working in the auditing assurance service group for Amos, Shawniwell, Eisen, and Otero LLP for the past 5 years. And an acknowledgement for all your hard work to promote you to manager with responsibilities, including the training of new associates. Following your promotion is a young associate named Ryan Jackson. Ryan is an eager, intelligent, and hardworking. However, he tells you he prioritized learning about taxation during college. Who would do something like that? And didn't really retain much from his auditing course. As a result, he doesn't recall much in the way of fundamental auditing concepts as part of his training. He decided to refresh Ryan on the components of the audit risk model. What are the 4 components of the audit risk model? Okay, so this should be a pretty straightforward one for the first one, okay? It's in the name. It's called audit risk, okay? What does audit risk mean? It's the risk the auditor expresses an inappropriate opinion on materially misstated financial statements, or probably more appropriately, they express a clean opinion on materially misstated financial statements. So we're saying it's basically the type 2 error from scientific testing and basically saying there's no problem when in fact there is a problem. That's a big problem with audit risk. How do we minimize audit risk? How do we leave audit risk at low? Well, we control the other components, or at least try to control the other components to some degree. 2 of those components are outside of our control, okay? First one is going to be inherent risk, okay? Inherent risk is the risk that's a fundamental risk to the entity's operations. So basically, whatever the line of business the organization is in, they're subject to certain risks that they have to be able to address. So we already know about that. When a risk exists, what do we implement to respond to it? It's not part of the question, Dr. Barnes. How dare you ask us stuff outside of the question? Controls, yes, responses to risk. Okay. Do controls always work? No, controls could not be present, or the controls could not be working properly. So there are still risks remaining after controls are implemented, which we call control risk. See what I did there? Yes. So risks that are still present after the entity takes action to address the inherent risk. So we know that there's risks that are present to the organization that are fundamental. Those are inherent risk. Control risks are saying, hey, our client has responded to those risks. What risk is still remaining? Once we identify that risk, then we can determine what we need to do for the last part, which is detection risk, okay? Detection risk is all in the hands of the auditor. That's the one where we say any risk that remains after planned audit procedures. We should be able to identify the remaining risk and respond appropriately. All right, so everybody got that down? You feel like you're experts on it? Good, I'm going to test you. All right, for each scenario, identify which component of the audit risk model the scenario most closely relates to. CapCorp has inadequate supervision and review over petty cash transactions. This should be a pretty straightforward one. Which one is it? Control risk. Yeah. Supervision review of petty cash transactions sounds like control. If it's inadequate, it's definitely control risk. Audit engagement team for Rosen Incorporated did not perform confirmations testing over Rosen's receivables. As a result, the auditor failed to identify a material misstatement in its accounts receivable. What do you guys think? That's detection risk. That is detection risk. Yep. Because its business model requires that it carries large quantity of inventory, E&L Enterprises assets are susceptible to theft. What do you guys think? That's inherent risk. Yeah, the base of the business model kind of defines the risk they're subject to, and that one of those risks is that people are going to steal merchandise from them. Halter Technologies operates in an industry that is highly competitive and subject to rapid change. What do you guys think? That is also inherent risk. Although the audit engagement team for Go Corporation was not able to obtain sufficient and appropriate audit evidence to justify its conclusions, the auditor issued an unqualified audit opinion. That is audit risk. That is basically saying that everything was fine when it was not. It is not fine. Okay. Which two components of the audit risk model comprise the risk of material misstatement? Inherent risk and control risk. So what does that mean? Basically means that when we determine what the aggregate, those aggregate two risks are, we can actually combine them and say, what is the total risk of material misstatement? What is that driven by? Is that like the average between the two? If like one's high and one's low, then we just say it's moderate. Is that how it works? No, it's basically depicted by whichever one's the lowest. Okay. So if we have high inherent risk and low control risk, we say risk of material misstatement is low. You say, why, Dr. Barnes? That doesn't make any sense. It's because you're thinking of math. Okay. Don't think about it about math. Think about it this way. Companies got really, really high environmental risks, but they said, look, we know we've got risks. So let's implement the best controls ever. And we're going to reduce our risk of material misstatement to nothing. Okay. So low control risk. Or conversely, if we say that their control risk is high, but they don't have any risk whatsoever. They operate in an environment where there's no competition, where they're the only people there. Like nobody's ever going to steal anything from them. There's like no inherent risks whatsoever. Like there's no business that exists by that, like by the way. But hypothetically, if they had no inherent risks, they could say it's still low risk of material misstatement. Okay, they don't need controls because they don't have anything. They need to have risks to address risks that are present. All right. What happens if I say control risk is high and inherent risk is high? What's risk of material misstatement then? High. Okay. So that's the scenario. We can have high as both. Okay. Which component of the audit risk model is the only one the auditor has control over? What do you guys think? Detection risk. Okay. So briefly explain the relationship between this component and the scope of testing the auditor must perform as substantive testing. This is actually extending behind that question that I was talking about before. We say control risk is high, inherent risk is high, which actually is most common scenario that auditors find themselves in. We would love it if controls would actually be fantastic and we could set control risk at low and risk of material misstatement as low. But let's think about those scenarios, okay? Let's think about the scenario where control risk is low and risk of material misstatement is low. What is that effectively telling the auditor? Saying, look, the client's provided a lot of assurance for us. We don't need to worry about doing so much testing because they've pretty much addressed all the risks themselves. If that's the case, we set detection risk at, so risk of material misstatement is low, detection risk is high. Yes, okay. Remember, high detection risk is good. High detection risk is good because that's the tolerance that we have for risk. If we set detection risk at high, we're saying we can tolerate a lot of risk in our procedures. Now, again, that doesn't make any sense. Everybody's want to say, no, if detection risk is high, that's bad, Dr. Barnes. Risk is bad. Just no, we're not talking about risk. We're talking about a tolerance for risk. Detection risk is high. What does that mean about the amount of work we have to do? It's low. We can do less intensive work. We can do less quantity of work. That's great. Okay. So again, it's a little bit like that situation where you're in class and you're just like, okay, I need to score 4% to get an A in Dr. Barnes's classes. Okay. What do you have to do? You have to show up and be conscious for the exam. Okay. That's basically it. Contrast that. What if we say, all right, control risk is high, risk of material misstatement is high, detection risk is low. Yeah, nobody fell for my trap. Everybody was like, so I thought maybe if I went that, they'd say high. Low. Do we like low detection risk? We hate low detection risk. That means we can only tolerate a little bit of risk in our audit procedures. It means more work, it means a lot more work, a lot more stringent work. We've got to vary the timing of procedures. We've got to be a lot more diligent about what we're doing. Okay. That's if you need a 90% on that final exam in order to get an A in the class. You're going to be doing a lot of studying to try to make sure you can get that A. You have a high chance of getting that A in the class. All right. So there's an inverse relationship between risk of material misstatement and detection risk. There's an inverse relationship between detection risk and the amount of work that we have to do in the substantive procedures. It means there's a direct relationship between risk of material misstatement and our substantive testing. Okay. Does that make sense? Yeah. Because if we say that risk of material misstatement is high, we're saying the clients have not implemented good controls. which means that we have a lot of work to do in order to make sure that we get proper assurance. If we say the risk of material misstatement is low, it means their controls are great or something about their operations are good. So we don't need to do a lot of work to get any remaining assurance. It all kind of ties back to each other. So understanding those relationships are really, really important. All right. That is the practice exam. Any questions? I almost said last chance for questions, but let's be honest, I've got office hours. And plus people email me. All right. So in between now and Wednesday, I have office hours tomorrow. You're more than welcome to email me outside of office hours. My one request is this comes up occasionally. If you decide that you have like 50 questions for me, okay, please don't put that in an email. All right. Optimally, come visit me during office hours. If you can't do that, if you can't coordinate that, set up a time for me. Trying to type out 3 pages of emails to answers to questions gets very, very challenging. Okay. And usually what I will do at this point in my career is I will say, look, I can answer those questions, but it would take me much longer to answer them than it would be just for us to set up a call and to talk about them. So face-to-face conversation for long discussions is good. If you have a minor question that can be answered within a paragraph, I'm more than happy to do that. Okay. Best of luck in your studies. I'll see you all on Wednesday.